Happy Friday, everybody. It is Jeannie Fisher, a certified financial planner and senior 401k advisor with Argy, and today we are talking to the individual investors, and I have so many ideas about investing videos that I want to do, but I couldn't really go into some of the more advanced without getting us a foundation video out there, starting at the very bottom of how we invest and why we invest. Now, in today's society, we can make money two different ways. We can work for it in our jobs, or we can reinvest the assets that we have and have them make money for us, and that's what we do when we invest. We're basically taking cash that we've set aside and we're asking it to go to work for us. Now, how do we do that? Well, we invest in different tools. The most common would be stocks, bonds, mutual funds, or some sort of business interest or real estate. And I'm just going to focus on the first three, and again, we're going to take it super low level because we need this foundation in place before we produce some more advanced videos. What is a stock? When you buy a stock, you are basically purchasing a portion of a company. You then have ownership in that company, and the idea or the goal is that that value of the company, the share, grows over time so that eventually you can sell that stock for more money than you paid for it. So if you own Apple shares, you have ownership in Apple. Now, bonds are the other type of investment that we see most commonly, and they are considered a little bit more conservative than stocks. When you buy a bond, you are actually lending money to somebody. You're lending them money, and they're going to pay you interest because they're using your money, and then they will eventually turn around and pay you your money back. Now, you can have more risky bonds, and you can have more conservative bonds. But in general, a bond is considered a more conservative investment than, say, a stock because there is a note on there and somebody is expected to pay you back your money. Doesn't mean that they always do that, but generally speaking, they do. So you can have varying degrees of risk, whether it be in a stock or whether it be in a bond. But generally speaking, stocks, or sometimes we call them equities, are more risky of an investment than a bond, or sometimes we call them fixed income. Now, most of you probably invest in something that is called a mutual fund. Now, what a mutual fund does is it allows the average investor to diversify a little bit more and capture some economies of scale. Now, your mutual funds will typically hold 50, some can even hold 100 or 1,000 different underlying actual holdings inside the mutual funds. You can have mutual funds that hold stocks, you can have mutual funds that hold bonds, you can have mutual funds that hold both. Okay, but for the average investor, it's a lot easier to make a diversified portfolio if you're buying mutual funds because they spread out the investment for you. Now, mutual funds were a great thing for a long time, but they do have some of their own weaknesses. And in the 90s, there was actually what I would call a newer, maybe faster, maybe a little bit sexier version of the mutual fund that was created called the exchange traded fund, or the ETF. Now, you might have heard of ETFs. They're a lot like a mutual fund in that you do capture the economies of scale and the pooled investment, but they do have some pretty big differences. Most of them tend to be invested passively or in an index, which we will talk about in another video. But one of the primary differences is that they trade intraday, whereas a mutual fund can only trade once at the end of the day. Mutual funds can be a little bit more expensive from an expense ratio perspective. Many mutual funds carry what is called a sales load or a commission, where there's a fee assessed either when you buy or when you sell the mutual fund. You won't typically find those in an exchange traded fund. Also, just because of the way they operate, mutual funds can have some tax disadvantages where maybe taxable gains are being distributed out to those who hold the mutual fund that you then have to pay tax on if you're holding the mutual fund in a taxable account. Now, that's where I've seen individual investors get a little tripped up. It is possible that you actually have taxable income from a mutual fund that you have to pay taxes on, even though the holding itself might actually be at a loss from what you originally paid for it, or even if you never actually saw the gain. So it can get pretty complicated how exchange-traded funds and mutual funds work behind the scenes, but generally speaking, an exchange-traded fund is going to have some more tax advantages. Now, I can tell you for us here at Argy, we manage a little over $2 billion in assets, and we definitely like the exchange-traded fund. Now, I'm the 401k lady, so I talk about 401ks a lot, and that line does get a little bit blurred because some of the advantages of the ETF on the individual market aren't actually available in the 401k. So we'll go into what you use where, but from an individual perspective, our company is definitely going to lean towards using the exchange traded fund. We do like some of the benefits that it has. So The next video, what I want to clarify is actually an investment versus an account. Okay, what types of accounts are there? How do we open them? What does that look like? Again, a really basic video because we want to build the foundation for us to dig into some more advanced investment videos. So that's it for today. I hope that you guys all have a wonderful weekend. I will be back again next week with another video digging more into investments. Thank you guys so much, and we'll talk to you soon.